Is this a change from what we've seen over the past 20 or 30 or 40 or 50 years at this point?
Thanks, Dom. There has been a change just over the past few years. And that big shift is the increasing dominance of these retail traders. And what we're seeing is that this new generation of investors that's been in the market since 2018, 2020, they don't remember the stomach churning crises of, say, the dot-com boom, the global financial crisis, when markets just took way, way longer to recover. And we've seen them just buy record amounts of shares, and they've been rewarded, right? The number of 401k millionaires out there at brokerages like Fidelity has hit records, and their finances are more intertwined with the stock market than ever before, making up around 36% of their net worths as of the first quarter. And what we've seen is that they have jumped in to buy the dip even when the pros have fled around Liberation Day, and they've kept buying the rest of the year. And this is a big shift from prior years.
This has been a building force, though, I would argue, over the course of the past 10 or 15 years, certainly since the great financial crisis, this idea that people are getting more active in the markets. But just what do you attribute this kind of latest rise in influence in the markets to the retail trader over? Has it been technology? Has it been Wall Street bets and Reddit forums? What exactly is driving this outsized influence now?
Dom, this has been a growing force since the global financial crisis, in part because 2008 was followed by the longest bull market in history. So anyone who entered was really rewarded, right? People who might have opened their first brokerage accounts in 2015, 2016 just saw stocks go really in one direction, up. But what's really interesting is that when you look at the data, 2008, which was a terrible year for the stock market, that was followed by 4 consecutive years of outflows for US equity, mutual, and exchange traded funds. So even after stocks bottomed, people kept yanking money out of the market. That is not what's happened the past few years. Take 2022, for example. Individual investors kept piling into the market in 2022, which was, again, a pretty terrible year for markets. They were quickly rewarded by the best 2 years for stocks in a quarter century. And of course, there have been tech changes, right? Brokerages these days have made it way easier to trade. Trading is more gamified. And I think that's kept more individuals in the markets.
At the end of the day, is this a good thing, Gunjan, that we have this type of activity? Does it mean that people are taking more control of their financial futures, but are also being accountable for the pitfalls that can go with it?
It's been a good thing for many individuals who jumped into the markets during times of turmoil. Just think about how much stocks are up since April, right? These individual investors keep buying the dip because they have been rewarded. And it has structural implications for the bull market today. I think it means that this bull market is built differently because you have this incredibly strong cohort of investors willing to jump in when things are falling apart, kind of even functioning the way short sellers might have in the past. They've just been an incredibly powerful force during some of the worst days for the market this year.